You probably clicked on this video because you've been trading for a while, but you've had struggles finding a profitable system. Don't worry, we've all been there, including myself. It can be very hard nowadays to find a system that you actually trust. There's a lot of influencers that are saying a lot of different things, but in this video, I'm going to show you a system that I know for a fact is profitable, and this was the system that got me my first ever funded account payout. Before we begin this video, there's certain things I need you to understand. No system is going to be profitable consistently if you don't stick with it and refine it. Now, you've heard this 1,000 times before, but I'm gonna say it again. Anything can work with anybody as long as they stick to it long enough and that they refine it. So your problem probably does not lie in your edge, but in yourself. You're simply not sticking to a singular system for a long enough time. Now, you also need to enjoy that system. You also need to be able to repeat that system. A lot of systems nowadays or trading strategies are simply too complicated and very, very hard to repeat. So in this video, I'm going to show you a simple trading strategy that I personally know from experience is profitable as long as you stick with it. So without further ado, let's jump into the first section of this strategy. Now, before we get started, there's a concept I need you all to be familiar with, and that concept is liquidity. I'm sure you've heard about it before, but I'm quickly going to go over exactly what it is. So if we take a look at this drawn out example here, the highest point of this trading range is what we call external range liquidity high. The lowest point of this trading range is what we call external range liquidity low. So I'm going to say it again. The highest point of a trading range is what we refer to as external range liquidity. So when it's the highest point of the trading range, that's called external range liquidity high. When it's the lowest point, it's called an external range liquidity low. Now, any highs and lows in between that, so that would be this high right here, this high right here, and then these equal lows right here. These are called internal range liquidity. So now that we got that out of the way, what is the difference between external range liquidity and internal range liquidity? Well, oftentimes external range liquidity is used for full take profits, and internal range liquidity is used to trim your position with partials. So again, a market has a much higher chance of reversing off of the external range liquidity rather than the internal range liquidity. That is why we use the internal range liquidity as take profit 1, 2, 3, and then external as take profit 4 and the final one. Not only that, but this down here is equal lows. That is a more significant liquidity pool. So when we have two lows that did not sweep each other, we have to look at liquidity as stop losses. Okay, stop losses is something that the market is attracted to. It's something that the market wants to accumulate. Therefore, when we have equal lows where this low did not take out this low, we have double the amount of stop losses, which equals double the amount of liquidity. So that is a point in price that price is very, very likely going to return to. So it's important that we know the difference between high probability liquidity and low probability liquidity. So in my opinion, internal range liquidity is the lower probability liquidity. The high probability liquidity, it's the equal lows and equal highs because there's simply way more liquidity built up around those lows. Now, not only that, if we take a look at this right here and we draw a trend line like this is something that we call trend line liquidity. Some people call it low resistance or high resistance liquidity. I call it trend line liquidity. And the analogy behind this is essentially every single trader has been taught how to use trend lines. So whenever you find a trend line within a market, there are likely thousands and thousands and thousands of stop losses placed here, here, and here, because we had people shorting the market here, here, and here off of the trend line bounce, right? So we know, because we know what original traders were taught, that their stops are placed here, here, and here. Again, because that is what they have been taught since the beginning of time. So that is also a significant liquidity pool. Now, it has, in my opinion, to be a more obvious trend line so that you're not confused as to whether other people will think it's a trend line. In this example, this is very, very clearly a trend line. So I'm not confused as to how many people shorted here, here, and here, because it's very obvious that that is a trend line. So again, looking at liquidity as stop losses in the market and looking at stop losses like something the market wants to take out. So for example, in this example, this low, which was the previous external range liquidity low, because this low had not been put in yet. So before this low was made, this was the lowest point of the range. So we took out the external range liquidity low, and we're now starting to see a move to the upside. So I can now comfortably start long in this market because I have trend line liquidity. So I know there's a bunch of stop losses here, 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 and probably also at the external range liquidity high. So at this point in time, we have swept the previous external range liquidity low, and we are now starting to move with volume to the upside. We have a bunch of stop losses here, here, and here. And then we have an external range liquidity high up here as well. So the reason why I'm telling you this is because the entry model or the trading strategy that I'm about to show you, it's very important that you understand where the market is going to go. I don't necessarily want you to look at this trading strategy as a mechanical trading strategy. You need to look at the overall context regarding the market. So for example, if we have just swept two equal lows and we have four equal highs up top, and then we see the pattern which I'm about to teach you play out, well, then you can probably long that market because you have a very significant liquidity pool up top. So what we're looking for in terms of the entry model is something that we call the ICT unicorn model. Some people explain this differently. I'm going to show you exactly how I used it to get my first funded account payout and just how I personally think that this strategy is supposed to be taught. So what we're looking for is something called a breaker block, and a breaker block is something that we form with a market structure shift. So again, if this right here, this high was an up close candle, what does that mean? Well, that means a green candle, a candle that closed green, right? So let's say that this high was an up close swing high, and it's important that it is a swing high. Now, what is a swing high? Well, that is when we have a candle here, a candle next to it, and another candle next to it. So it's a 3 candlestick pattern, and the one in the middle has to be higher than the two next to it. So let's say that this one here was an up closed swing high. What we would be looking for was a candle closure above here and then a fair value gap to align with that. So what we would want to see is a fair value gap being made in this displacement leg right here. Let me turn down the opacity. There we go. And then that fair value gap overlaps with the breaker block. That is the ICT unicorn model, and that is exactly how it's supposed to play out. Like that. Essentially, it's supposed to be a regular break and retest pattern like you have been taught, just a way more specific way of identifying it. Now, just like the old school break and retest pattern, it is very simple and easy to recognize, and it's also very easy repeatable, which is one of the most important aspects of being a trader. Finding a system that is repeatable, okay? So this is repeatable and it has a very high chance of playing out. It has a high strike rate. So let me quickly show you some chart examples of this playing out so that you are not confused as to what it looks like on an actual chart. So the first example I'm going to give you is going to be a bearish version of what I just showed you. I just showed you a bullish unicorn on the drawn out example. I'm now going to show you a bearish unicorn on an actual chart. So if we take a look at my screen, we can see that we have just swept external range liquidity. Now remember what I said, external range liquidity is way more likely to cause a market reversal rather than internal range liquidity. Now what is internal? Well, that is these highs, right? Because these highs are the highs that is made in between the high and the low of the range. So that is what we call internal range liquidity, and that can be used for, again, partial points, break-even points, and all these different things. And this is likely used as a take profit because, again, it is way more likely to cause a reversal. So we've just hit external range liquidity, and we are now starting to see some bearish displacement. Now, what is displacement? Well, displacement is essentially just when the market moves very fast with a lot of volume. So these two candles are displacement candles. And another thing that we had here is a bearish SMT. Now, if you don't know what that is, an SMT is essentially when you have two correlated assets, which means the chart generally looks the same. In this case, I'm charting on the NASDAQ, and the correlated pair for the NASDAQ is obviously the S&P 500. So the S&P 500 had swept this high. Meanwhile, the NASDAQ failed to sweep this high, which is why I'm interested in this displacement. So now we've swept the external range liquidity, which we've just looked at. The market is obviously very far up in the premium. Some would say it's an overvalued market. We also have a bearish SMT that caused a displacement leg. Now, what I want to pay attention to here is a candle closure below the first down closed swing low, or the most obvious down closed swing low. So in my opinion, that is going to be this one right here. We have a down closed swing low, and what does this overlap with? Well, it overlaps with this fair value gap right here. So again, that is going to be an ICT unicorn model, and that is exactly where I want to get in. So I'm going to place my stop at a reasonable level, preferably above 50% of this small range. So I'm going to use my premium and discount tool. And again, my stop is above 50% of the range. And the reason why I like to keep my stop above 50% of the small range, which I'm entering off of, is because if the market wants to do a pullback, it's likely not going to go a lot further than 50% of the range. So that is exactly what I would do. Now, again, where am I going to place my take profit? I'm going to place my take profit down here, and I'm going to use these internal range liquidity lows for partials and break-even points. So for this specific example, I would take 50% of my position off at this low, and I would let the rest run towards this low right here. So if I now hit play, let's see exactly what happens. So at this moment in time, I would have taken 50% of my position off because we've swept the internal range liquidity low. Now I would let the rest of the position run until this low right here. Now you could hold until external range liquidity, but that is all the way down here. And in my opinion, that is a little unrealistic, right? That is what you leave runners for. So let's play it out again and see what happens. And as you can see, the market came pretty close to stopping us out break even, but eventually we did hit take profit utilizing the ICT unicorn model. And again, it's a breaker block. Now, some would classify this as a mitigation block, whatever it might be. The difference between a mitigation block and a breaker block is whether we swept liquidity before creating the market structure shift. So this would in fact be a breaker block because this high took out this high before creating the market structure shift, okay? Now, you don't need to pay a lot of attention to that. A lot of people will tell you that you cannot use mitigation blocks for unicorn models. I simply do not agree at all. It does make the trade maybe a slightly lower probability trade, but overall you're going to get the same exact results. So here on the second example, we're still charting on the NASDAQ, which is a futures asset. Now this also works on forex, stocks, and crypto. And in this very example, we see it play out multiple times. And I'm going to show you exactly what I saw. I want to have context, right? I want to have a reason for price to go higher at this point. So what could that be? Well, I could use my optimal trade entry tool of the entire range, and let's see how the market reacted to that. So the market immediately started consolidating once it hit 0.618 of this trading range, which again is a great sign for me that the market wants to go higher. So we currently have optimal trade entry, which held beautifully and pushed price higher, right? Now, not only that, we also have equal highs up here, which if you remember, I told you in the beginning of this video was a significant liquidity pool. So again, we have the optimal trade entry of the entire range sending price higher, and we have equal highs. That's all I need. Now I'm going to look for that exact pattern, which I showed you. So the first time that this pattern plays out is right here. That would have been the first entry you could have gotten, because again, this is an up close swing high. And what does that overlap with? Well, it overlaps with an imbalance, okay? So what I would do if I took the trade right here is I would place my stops at this low, and I would place my take profits at the equal highs up here for about a 3.6 RR. Now again, not only that, but if I take a look at this up close swing high and draw like that, that also overlaps with this imbalance right here. So currently we have one down here, which was the fastest and best entry you could have gotten, maybe slightly riskier. And then we have this one right here. So again, I could have two positions rolling. The first one being here, the second one being right here. Now I want to place my entry at the actual breaker block high, so here, and not the beginning of the gap. That is my personal preference. That often gives me a better entry. Now there are some times when I will get left behind, but that's okay. So this right here is again the first position playing out from down here, and now we're going to enter off of the second position right here. Let's see if we're going to end up getting filled on this one. And as you can see, it just played out perfectly both times that it appeared. But why did this play out perfectly? Right? The only reason why I trusted these two to work is because I did the overall market analysis. I looked at the context of the market, right? I used optimal trade entry, and I saw that that was holding, and I realized that we had equal highs, which probably means a bunch of stop losses at the highs, and therefore I had a reason for the market to go higher and not go lower. Now I really hope that this video helped you out. If you want more help from my side, I do have my own private community where I live stream from Monday through Friday. That is the New York AM session session where everybody tune in and ask all the questions that they want. We do chart analysis, we do journaling, we do executions, we do everything together. So send me a DM on Instagram if that is something that you are interested in. Now again, this system has to be practiced over and over again, just like anything else in life. You are not going to become better at skateboarding by buying a new skateboard, right? The way that you become better at skateboarding is by using the same skateboard over and over and over and over again. That is the only way to improve in anything in life, and it is the exact same way in trading. So stick to this system. If you don't currently have one that you enjoy, this one is very, very easily repeatable. Now, I don't care if you go in and lose your first 5 trades, you keep on trading this system. You keep on refining it, and eventually, I promise you, you will see results. The reason why 99% of people simply do not win in this industry is because they cannot stick with anything, which is also why it's very, very easy for people like me who have spent a long time building discipline to simply outwork everybody in this generation. Now, I believe that you can do the same, especially after watching this video. This was Malik from the Skyline Traders Club. Thank you a lot for watching.